Good afternoon, everybody. I'm John Bagley, the Chief Market Structure Officer for the MSRB. Appreciate everybody showing up to see our mid-year market summary. For those of you who may have been on the call we did in January for the year-end 2025, the feedback we got is people would like us to do more webinars. We didn't think there was enough to talk about at the end of the first quarter, but we certainly think there's plenty to talk about mid-year. I think you'll find that we're going to focus on two things. One are trends that are continuing in the marketplace, and the second thing is new trends that we are seeing emerging in the muni marketplace, which is changing now more than ever. One thing for logistics, we welcome questions from anybody who's there. So if you have a question, please put the question into the chat. We will try to get to as many of those questions as we can. And especially put it in right away if it's related to a certain chart, so we can have a chart up while we discuss it. So with that, I'd like to get started because we have a lot to cover here today. Okay, so for the agenda, we're going to talk about what I deem to be, and we deem it in MSRB, to just fundamental changes we're seeing in the municipal securities market. We'll take a look at trading volumes, both in terms of par value as well as trade count. We're going to give you some information on data we get from ATSs, obviously a big part of the market overall. The big news of the half probably is new issue volume, again on pace for a record year, so we'll talk about that and some of the factors behind that. We're doing an overview of investors because demand has been very strong in the first half, which has enabled the calendar to be really kind of done very easily in the scheme of things. So the market really digested the calendar without much problems despite the record issuance. We'll talk a little bit about yields as well, and then go through and talk about a little bit of the recent MSRB research we have, and also some final thoughts. So we'll really get started now. And first thing, as we said, we want to talk about fundamental changes in the marketplace. And when I've done a presentation similar like this recently, we really do talk like the market in 2026 looks nothing like the market did 5 years ago. Trade counts, par amount traded, number of offerings, number of bid wanteds, et cetera, are all just at dramatically different levels than they were. And technology is enabling the market to do this. And it's enabling the market to do volumes we had never seen before. I also want to talk about, the benchmark tax exempt yields, recent research we put out when we look at what causes spikes in volumes, what causes large trading volume. It's yields. And it's also the volatility in yields, the huge correlation between where yields are and where trading volumes are. And that holds through very high rates and very low rates. A big thing we've been looking at is the electronification of the municipal securities market. Well documented that there is a growing number of algorithmic trading functions, both on the buy side and the sell side. And we'll show a graph that shows just how dramatically algorithmic trading can change trade count for a firm. We also, and we wrote about this in a couple pieces, we're seeing really dramatically increased buy-side account activity on electronic platforms. They're much more aggressive. They are doing trades and ended up trading with each other. And we'll also talk about tools that have really enabled the market to handle this unprecedented volume. ETFs is something everybody's been talking about and the growth we've seen in them. SMAs continue to grow at a significant rate and are a huge source of demand in the marketplace. And obviously, continuing borrower needs from municipal entities is the reason for this record new issue volume that we've seen. So if we talk about trade volume, if you go back to 2025, we had 17.6 million trades, which was the fourth consecutive year of record trade count. It was up 22% from 2024 and way more than double just what was the trade count back in 2021. And when I talk about that, those numbers can speak to it, but I think these numbers really talk about how the market's changed fundamentally. So if you go back prior to April of 2022, and if you recall, that's when rates started to rise, there were more than 1 million trades in the marketplace only 8 times. And all of those times could be associated with some market event. The last time prior to 2022 was March of 2020 at the onset of COVID. There were 3 instances during the credit crisis in 2008. But anyway, if you looked at all 8 of those, there was a reason that you could point to and say why trading went up. So it really was not a commonplace at all. And quite often we had years where we didn't have 1 million trades in a month. In 2022, it really started to change as rates rose. And in fact, in the last 9 months of 2022, 8 of those months had more than 1 million trades. So from 2005 to 2022, you had 8 months. And in the last 9 months of the year, you had 8 months again. And then if you go to April to 23, and again, that's when we saw rates really rise, we've had 1 million or more trades in 36 of the last 37 months. So really every month, obviously, but one. But the market really didn't stop there, because in 7 of the last 9 months last year, we saw more than 1.5 million trades. And over the course of the last 14 months, the average number of trades we're seeing a month is 1.46 million. So just a dramatic change in a marketplace that really never saw 1 million trades a month. And now 1.5 million, 1.4 million, 1.5 million is commonplace in the marketplace. So let's talk a little bit about trading volumes this year. When we did our year end for last year and we talked about looking ahead, we said that we thought it might be difficult to get a 5th consecutive year for trading volumes records. And so far that is holding true. So year to date through the end of June, par value was 1.7 trillion, down about 10% from what we saw in 2025. Also, for a number of trades, we had 8.5 million trades, down 3%, so pretty close, but still down a little bit from the record pace we saw last year. And a trend, and we talked about trends that might be new and some that continue. One that certainly continues is that average trade size in the marketplace continues to decline. For the first half of this year, it was right around 205,000. That's down from 214,000 for all of last year, and down from 291,000 in 2021. So, trade count, as more people have gotten involved in smaller size trades, we just continue to see average trade size decline, which to me is consistent with a market that is going more and more electronic. So a couple of graphs to back up the trading volume. This shows you the number of trades over the from 2005 to 2026. You see these 4 consecutive years of record trade count, interestingly occurring right after the record low trade count in 2021. And if you go back to 2020 and 2021, we had record low rates, and record low rates correlated with record low trade count. This year, again, we're a little bit behind where we were last year, but we're in the ballpark. In terms of par amount traded, this graph goes back to the same period of time, and I like to point out, you can see that even last year, we're nowhere near the record trade par amount traded that we had in 2006 and 2007. And we break this chart out by fixed rate in green and variable rate in blue. And the reason it's so low is if you go back pre-credit crisis, so back to 2006, 2007, there was actually more par value traded in variable rates than there were in fixed rates. So, we haven't come close to those volumes reached, but last year we did have a record year for fixed rate traded. So, again, we expect the par amount this year to be behind where we were last year, but likely right up there with maybe the second highest year prior to 2009. Our average trade size we show you, you can see, the correspondence of variable rate shows. If you go back to 2006, 2007, you had huge average trade size because of the variable rate trades tend to be very large. If you start getting more recent, since 2020, we've seen a real steady decline in average trade size. And again, we just think that's a market that's consistent with electronification, and that's consistent with more people caring about odd lot transactions in the market. So we talked a little bit before about algorithmic trading, and I wanted to show this chart about the impact of dealers starting up an algorithmic trading desk. And what this graph shows, and this is just one of many we have, we use various ones, and as you can see, we don't have any dates because we don't want to know who it is. And 0 is not necessarily 0 trades. It's the baseline of how many trades they were doing in an average month prior to opening up an algorithmic trading desk. And this pattern you see here on your screen is dramatic, but it's also consistent. We consistently see this happen. And so a firm with a baseline number of trades within about a year's period of time, all of a sudden routinely has 40 to 50,000 more trades per month than they had prior to starting an algorithmic trading desk. And like I said, this is just one of many examples. We use various timeframes. It's not one that just started. This started a while ago, but the same pattern always really does emerge. And algorithmic trading in general is more concentrated on the smaller size trades. So you see trade count just rises dramatically in a short period of time. And once it gets up there, it has really maintained that 40 to 50,000 trades per month. Oh, and I should say, when we do that work, right, that analysis that we did requires the dealer identifier. We obviously at the MSRB have it, and that's why we try to make that information available. Anonymizing, obviously, who the dealer is, so you don't know, but showing sort of trade patterns that emerge when a firm starts an electronic trading desk. The last graph I have in this section is related to ETF volumes. So, we talked about real large growth in ETFs, and, ETFs are, depending on what quarter you look at, 3 to 4% of the outstanding municipal debt is in ETFs. So still small, obviously, relative to mutual funds. But what we definitely see, and our research recently has shown this, is the volume in trading in municipal bond ETFs rises substantially whenever we see an increase in market volatility. And so if you look at this chart that goes back to the beginning of 2025, and you see that very large uptick, that's April 9th of 2025. And April 9th was the single largest day of trading we ever had. There were 113,000 trades in the municipal market that day, the only time we've ever gone over 100. And that number was probably 38% over the previous 30-day moving average. So we thought that was a huge jump. On April 9th, the top 11 ETFs had $6 billion in trading volume, which was 6 times the 30-day trailing average. So, and you can see if you look at where any of these spikes are, they all correlate to some significant market move. And what this says to me is some large buy-side and sell-side firms and other firms are using the ETF market to change their exposure to the municipal market quickly, either getting more exposed or less exposed, and using the ETF path to get there. So we put a research report out on this that I highly recommend you read, because if you only look at the dollar value of ETFs, I think it underestimates their importance in the marketplace. And this chart shows you just how important they become when the market gets volatile. Okay, we have a question that I see now. Is electronic market the biggest factor in increased number of trades? Joe, yeah, I see a question. I think it is, because and a lot of electronification is not just a trading function, right? It's also on the buy side being able to have lower minimums on SMAs, et cetera. But yeah, I think the electronification of the market has enabled the market to handle this kind of trade volume. It also, we'll show a chart later that shows this, has had more firms on the buy side care about smaller size transactions. I mean, if you went back 10 or 15 years, most large buy-side firms wouldn't care about a 50 bond piece out there, maybe if they had matchers. Now they care all the time, and we'll actually show a report we have that shows that institutions actually execute more than half the customer trades in trades of 100,000 or less. So yeah, Joe, I do believe that the electronification of the market has enabled this market to grow at a pace that frankly would not have been possible without it. Okay, we track ATS data from a summary level. A few of the ATSs give us their data. And again, it's summary level data. We don't see the offerings, we don't see the bid wannets, but we do see how many they have on a daily basis. And one of the ATSs put out a piece that says they could have 125,000 unique securities quoted on their ATS platform on any given day. But the numbers, so we talked about how much trade count and par value has grown over the years, but the number of offerings on ATSs and the number of bid wannets has grown dramatically more. So average day so far in 2025, you saw 33 billion in par amount on a single ATS platform, and average quotes of somewhere near $250,000, and up 6% there. But if you go back to 2023, you see the par amount is up by more than 50%. and the number of daily quotes has almost doubled in just 2.5 years or 3 years. Also, one thing we track closely on ATSs is the number of customer trades executed on an ATS. And for the first half, that was about 21%, meaning that 1 in 5 trades are occurring, customer trades are occurring over an ATS. What's the portion market is held by ETS? Steve, you had a question about ETFs. The last Fed data I saw, I forget if it was either 3 or 4% of the market is held by ETFs, or 3 to 4% of the market. I think mutual funds were about 21%, and individual investors, which include SMAs, were 47%. And that was data from the end of 2025. The other stats related to an ATS, they obviously are a huge part of the interdealer market, and they account for about 53% of the interdealer trades that happen over an ATS. A much smaller amount of the par amount, because again, trades on an ATS tend to be smaller than trades in general. So as much as the quote market has grown, the bid wanted market on ATSs has grown even more. For so far this year, ATSs are having 29,000 average day, an average number of bid wanteds on one ATS. It's about 29,000. That's up 15% from last year, and it's tripled since 2023. So you just see a dramatic increase in that. And again, the same pattern we see, the par amount is up as well, but not up nearly as much as the number of bid wanteds. Bart, please repeat. Please repeat the questions. Okay, I will do that. Thanks, Bart. I've only done 2 of these, so I'm learning as I go, but yes, I will repeat any more questions we get. Okay, so to me, the real story so far this year has been the new issue volume. So trade count's down a little bit, looks a lot like last year, but a little lighter. But new issue volume continues to grow and is at, again, another record pace. And the chart here shows new issue volume from 2015 through the first half of this year. And you can see the 2 record years we have in 24 and 25. And this year we're more than halfway there. So, if this continues, you'll see a 3rd record year. And one thing I like to point out is, as much as you've seen trade count grow dramatically, new issue volumes has not grown nearly as much from 2020 or 2021. And if you go back, it's because if you remember back in 2020 and 2021, we had record low rates. You had all the questions around COVID. And so you had municipalities go and issue taxable debt to refund tax exempt interest. And then they could take the savings up front, and obviously gave them a lot of relief in a time that was uncertain. And, if you go back and look in those years, the taxable market was 25 to 30% of overall volume. If you go back now, it's more like 6 to 8%, which is the norm. The only times we've seen taxable volumes that really high are 2020, 2021, and back to 2009 and 2010 at BAB. So though the volume's up, it's really changed dramatically. The volume now is being driven by new money issuance, although we have seen a slight uptick in refundings so far in the first half. So just some stats. I'm not going to go through all these, but so far new issue volume's up about 5% year over year. Remember last year we had 587 billion. We're at 299 billion so far this year. Again, tax exempt issuance up 7%, but refunding issuance is up almost 50% on the year. So obviously a lot of bonds probably maturing that issuers are taking out, and though rates are higher than they were a while ago, they obviously are lower than they were for most of 2025. So pretty significant increase in refunding so far this year. The other thing I think I want to talk about is we've been tracking private placement volume for a while, and that was about 6 billion, which was 2% of issuance. That's down 7% year over year, but just for comparison, in 2023, private placement volume was 22 billion, and this year, we'd be on pace to do about 12. So we have seen over the last few years a consistent and significant drop in private placements. The last chart I have related to new issue is something we read a lot about, and it's related to the prepaid gas deals. And this chart is from 2016 through the first half of this year, and it shows you the issuance in prepaid gas deals. And you see this dramatic rise starting in 2021, continuing all the way through last year. And last year we issued just over 30 billion in prepaid gas deals. For the first half of this year, we're 23 billion plus. So unless something dramatically changes, we're going to be well through where we were last year. And prepaid gas issuance was about 8% of the overall volume in the first half of the year. And so if you go back and you see this consistent increase in new issue volume, obviously the increase in prepaid gas deals has been a significant factor there. So a little bit of an overview for investors. So I would say what's been characterized this year in the first half has been very, very strong demand and better demand from across various investors than we've seen in a while. So we'll start with ETFs, inflows of 33 billion this year, first 6 months of this year. Last year was a record year at 61.5, so on pace to be ahead of that. And then if we look at tax-exempt mutual funds, and to me, this is one of the big stories. Their net inflows were also about 33 billion for the first half of the year. And to me, this is a huge positive development in the marketplace because last year they only had 15 billion in net inflows. And the mutual funds tend to be the buyer of one of the significant buyers in the long end of the market. So having ETFs getting significant inflows, having mutual funds having significant net inflows, and then having continued growth in the SMA business has really been the source of demand in the marketplace, because we know banks and insurance companies have continued to decrease their overall exposure because of the low corporate income tax rates. And this change in mutual funds is significant because, again, if you go back to 2022, when rates started to rise, from 2022 to 2025, mutual funds had total net outflows of about $120 plus billion, while ETFs had net inflows of $120 plus billion. So you saw a real fundamental change in where investors were putting their money. This change with mutual funds and ETFs now bringing in significant positive cash flow, to me, has been a major factor in the market and a major reason we've been able to have this new issue calendar with really very few problems at all in the marketplace. So overall, in the municipal space, we know, right, we have a narrow investor base because pension funds and foreign investors don't do a lot. The market is still heavily reliant on individual investors, which include SMAs, obviously, but also includes mutual funds and also a significant portion of ETFs. So the market remains really reliant upon the individual investor, however they prefer to get their exposure in the municipal space. The other thing I'll talk about for investors, we've mentioned a little before, really the buy-side accounts have become much more electronic, much more aggressive on the marketplace. So again, more than half of the customer trades that are being executed in the marketplace are being executed by institutions, not by individual investors. And then the other thing we tracked this year, we got a call from a stakeholder who said, I think there's more customer-to-customer trading on ATSs, meaning no dealer provided liquidity in two trades that happened. And so, again, using the dealer identifier, we were able to do some work and find this out. And in fact, they were right, because in 2021, about 4% of all customer trades were customer-to-customer trades on an ATS. That number has grown to 7% in 2025. And if you remember that about 21% of all customer trades are executed on an ATS, that means about a third of the trades on an ATS don't involve a dealer except the dealer of the ATS just transacting, right? The ATSs don't carry inventory. So it's a customer on the sell side and a customer on the buy side. So a significant jump in just a few years. This is the Fed holdings data we mentioned before. Coleman's got a question. So the question is, have you seen any change in the average life of debt finance to take advantage of the growth in SMAs? Rick, we haven't looked at that specifically, but I will tell you one place we have seen it. I've heard this from a few people. We talked about prepaid gas deals, and the way prepaid gas deals were structured prior was they were a 30-year maturity, but they had like a 10 or a 12-year put. And I guess word got around that was difficult for SMAs to have. So if you notice the deals that have come this year, they normally have small amounts coming out to 9, 10 years, 11 years, and then a very large term, billion bonds in 12 years or 14 years or 10 years, et cetera. And that was really to try to take advantage of the SMA business. I also heard that, if you go back to when mutual funds were not bringing in significant assets, the hardest part of any deal to get done was the long end of the marketplace, because as a general rule, and not definitively, SMAs tend to be shorter on the curve than mutual funds are. ETFs, as a general rule, tend to be a little shorter on the curve than mutual funds. So I did read that there were some municipalities that were trying to change up their structure because there was so much more demand in the first, let's call it 10 to 15 years. And I think that still holds today, because, if you look at the muni treasury ratios, through 10 years, they're through 60% at this point, which, is kind of historically an unattractive level, but it's possible because there's just so much demand in that part of the curve. Okay, we'll talk about yields a little bit. This is 10-year tax-exempt yields going back to 2011. And the thing I want to mention about this chart is, you kind of forget how long we were in a very low interest rate environment. So if you go back to 2000 and, if you go back to before the first quarter of 2022, we had very low rates. 2020 and 2021, 10-year BVAL was right around 0.5%. So, and then if you go back, you see that one big spike, which was the COVID, which was very short-lived. But if you look at where rates are now, really, before 22, you have to go back to 2014 to see where they are. So again, I think the test for this market will be, if rates continue to go down, will demand continue to follow in its current format, or will it change? Because again, we see that overall trading volumes are highly correlated to where rates are. But on the plus side, we still are at significantly higher rates than we have been for most of the last, 12 years or so. And again, we talked about this. This chart shows two things. It shows you the number of trades, which are in the green bars, and where 10-year benchmark yields are. And what this analysis showed us is there is a tremendously high correlation between where yields are and where the number of trades and the par value are. And so if you look going back to 2021, you see how rates really started to shoot up, and so did par amount, so did the number of trades really shoot up. And if you look at 2020 and 21, and you see it really went down, as rates went down, trading volumes went down again. So I really do encourage you to read this report. It does really show that, a lot of what we see in trade volumes is really dependent upon where yields are. And then just a couple of final thoughts for you. I have here a list of the research reports we have recently. Just so everybody knows, we are going to make these graphs, this presentation will be made available on MSRB.org. So if you miss something, you go back, you can get it. We'll have it up there very quickly. But I encourage you to take a look at some of these. You can see the last one is the Midyear 2026 market summary we did, which is where all this data came from, and shows where the market has changed so significantly. And then finally, some final thoughts. The market has been really what it is because of this vibrant growth in SMAs and ETFs. The ETF market is even more important when the market gets volatile. We continue to see and don't see any stop in live quotes and bid wanteds. As people electronify, they can handle more, they can put more out, they can bid on more, and so the market continues to handle it. And the other thing that really I mentioned, right, is one of the reasons we've seen this dramatic increase in SMAs is because of electronification, SMAs have been able to really decrease their minimum size account. They used to be like 10 million or 5 million, and now I think I've heard it can be 250,000. And I think that has dramatically helped the growth in SMAs and the cause for what we've seen. And again, yields are important for where we are. And everything points to issuers are still going to have fundamental needs. So we expect new issue volume to be a record for the third straight year. So I did it in exactly 30 minutes. So that was pretty good timing. Let me just say again, this presentation will be available for anybody that wants it. If you go to msrb.org, you can see the research that we reference, but we also, in this presentation, are providing you with links. So if there's anything that's interesting, you can click right on it. And then also on msrb.org, you can get various statistics, or on Emma, you can get market statistics as well. Listen, we had a great turnout today. We had this, I know somewhere between 250 and 300 people sign up, which we just think is great. We appreciate everybody willing to come on and spend some time. I hope this was helpful for you. And know that if you have any feedback and like to tell us how we can make this better for you, we would certainly like to incorporate it before we do it again. So again, thank you very much, everybody. Enjoy the rest of your day.